Two investors can own basically the same portfolio, live through the same market, and still end up with very different wealth for one quiet reason. One account has a tiny leak. That leak is fees. And the real damage is not just the fee you pay this year. It is the future compounding that fee prevents. That is the calm truth most people miss. Fees are not just a line item. They are negative compounding. They quietly reduce the base your future returns get to grow on. So here's the whole principle up front. Tiny investing fees matter because your wealth grows at the net return you keep after costs, not the gross return you hear about. The rule in this video is simple. Protect compounding by paying close attention to ongoing fees. This is educational, not personalized financial advice. I am not telling you what to buy. I am showing you a piece of investing math that applies broadly, whether someone uses index funds, ETFs, bonds, or other diversified investments. Think about two buckets being filled by the same hose. If one bucket has a tiny hole near the bottom, it may not look like a big deal in the first few minutes. Both buckets are still filling. Both seem to be doing fine. But leave that running for a long time, and the difference becomes obvious. The bucket with the leak never gets the full benefit of the water going in. That is what an annual fund fee does inside a portfolio. It is usually not a dramatic bill that arrives in the mail. It is often deducted quietly in the background. That is exactly why people underestimate it. A 1% fee sounds small when you hear it as a yearly number. Next, to a market move of 10 or 20%, it feels almost trivial. But math does not care what feels dramatic. Compounding is simple. Your money earns returns. Then those returns stay in the account and can earn returns too. Over time, growth starts building on a larger and larger base. That is why long-term investing can work so well. The snowball gets bigger, so each turn can pick up more snow. Now, flip that around. If a fee trims the portfolio every year, even by a little, the next year starts from a smaller base. And then the year after that starts from a smaller base too. So you are not only losing the dollars taken out today, you are also losing all the future growth those dollars could have earned for you. A good way to picture it is this. Imagine planting a seed every year, but before you put it in the ground, someone takes a small bite out of it. The immediate loss looks tiny, but the real cost is the smaller tree that grows later. A fee is not just a charge on this year. It is a claim on your future returns. Here's the part that matters most. Investors often focus on gross returns. They ask, what did the market do? What did this fund earn? What was the headline number? But your life is funded by net returns. Your account balance compounds at what remains after costs. That is the number that actually builds wealth. Let me make this concrete with one clearly hypothetical example. Imagine two investors. Same starting balance, $10,000. Same ongoing contribution, $500 per month. Same broad portfolio, same market, same discipline. The only difference is cost. Say the underlying investments earn a rough 7% a year before fees over a long period. Investor A pays a very low ongoing fee of about 0.2%, so the net return is roughly 6.8%. Investor B pays about 1.2%, so the net return is roughly 5.8%. That 1 percentage point gap does not feel like a crisis. In a single year, most people would barely notice it. If the market is up strongly, both investors may still feel good. Both accounts may show gains. And that is exactly why this gets ignored. But now extend that simple example over 30 years. With those illustrative assumptions, Investor A ends up with about $620,000. Investor B ends up with about $540,000. That is a gap of about $80,000. Same market, same savings habit, same broad exposure. No magical stock-picking difference. Just a quieter drag taking a little off the top every year. And notice what created that gap. It is not just that Investor B paid some fees along the way. It is that each year of fees reduced the amount left behind to compound in every future year. The leak kept working. The backpack stayed on. The snowball kept getting shaved down a little at a time. If you want an even more everyday way to think about it, imagine getting a raise every year, but a small automatic deduction also increases with your paycheck. At first, it barely changes your lifestyle. Years later, it has shaped how much you were able to build. Ongoing investing fees work in a similar way. They do not usually hurt enough in one moment to force your attention. They just quietly change the ending. This is also why higher costs create a headwind. A more expensive approach starts slightly behind every single year. Before it can merely match a lower-cost alternative, it has to earn enough extra return just to overcome the fee gap. That does not mean every higher fee option is bad, and it certainly does not mean all paid investing help is a scam. That is not the point. The point is that the math demands a reason. If you carry a higher ongoing cost, something has to justify that drag, and this is where behavior comes in. Many people will spend hours trying to find the best manager, the hottest theme, or the smartest forecast. They will compare stories, personalities, and recent performance, but they will barely compare costs. That is backwards. Future returns are uncertain. No one can control what the market will do next year. No one can guarantee which strategy will look best over the next cycle. But fees are one of the few variables you can actually observe. They are one of the few frictions you can often reduce. In investing, the controllable things deserve more attention than the exciting things. There is also a psychological trap here. In a strong market year, people log into their account, see green numbers, and feel everything is fine. The gain is visible. The fee is not. The market did the emotional work, so the cost feels invisible. But invisible is not harmless. A small fee taken quietly in an up year still permanently trims the portfolio. Another detail that people miss is that fees do not pause just because markets are messy. If returns are flat or weak for a period, an ongoing cost can feel even heavier because less growth is available to absorb it. In good years, the fee hides inside gains. In dull years, it can take up a larger share of what little progress you made. Either way, it is still a drag on net returns. So the principle I want you to remember is what I call the leaky compounding rule. When returns are uncertain, guard what you keep. Do not just ask what an investment might earn before costs. Ask what actually stays in the account to compound for you. That does not require obsession. It does not require predicting markets. It does not require finding the perfect product. It means understanding the mechanism. Broad diversification matters. Time in the market matters. Staying invested matters. But low ongoing costs matter too, because all of those other good habits work through compounding, and fees are a direct tax on that engine. Think of it like running a long race with a light backpack you never take off. In the first mile, it seems manageable. Over the full distance, it matters. The investor who respects costs is not trying to be clever. They're simply refusing to carry unnecessary weight for decades. The mistake that wrecks this is not usually one huge error. It is casual neglect. Ignoring a small percentage because it sounds harmless. Chasing a flashy gross return and forgetting that your wealth builds at the net rate. Assuming that because a cost is quiet, it is unimportant. The calmer approach is better. Learn to see fees for what they are, not tiny annoyances, but recurring claims on future compounding. Then build the habit of evaluating investments through that lens. Not what sounds impressive, not what looks exciting. What do you keep and what keeps compounding? That is the long-term win here. You become a patient, systematic investor who understands that wealth is usually built slowly. You stop obsessing over flashy numbers before costs and start protecting the quieter number that actually drives outcomes after costs. Tiny fees are not tiny over a lifetime. They are small leaks in a very important bucket. If this helps simplify the way you think about investing, keep that rule with you. Protect compounding by paying attention to net returns. And if you want more calm, evidence-based videos like this, subscribe, and I will see you in the next one.